Well, good morning. I didn't look at my watch, but I know it's 10 o'clock. So let's call the February 9th, 2023 meeting of the retirement system to order. Item number 2 on our agenda this morning is to approve the minutes of the meeting of January 13th, 2023. I have a motion and a second. Please record your vote.
He's absent.
I vote yes.
He votes aye.
Yes.
Item is approved. Item number 3 is the consent docket. We have 2 items. We can take those with one motion. I have a motion and a second. Please record your vote.
I vote yes.
Motion is approved. Item number 5 is to ratify approvals. We have one item. I'm sorry, item number 4. We have one item. I have a motion and a second. Please record your vote.
Yes.
Item is approved. Now we'll do item number 5, which is to approve the claims docket. I have a motion and a second. Please record your vote.
Yes.
Item is approved. Item number 6, approve the following applications for service retirements. I have a motion and a second. Please record your vote. Item is approved. Item number 7, receive report of death, approve continuation of pension to spouse. I have a motion and a second. Please record your vote. Item is approved. Item number 8, receive report of death, authorize payment of the $5,000 death benefit, and authorize the secretary to make necessary changes to conform on the following. We have a motion and a second. Record your vote. Item is approved. Item number 9, receive report of death, authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item is approved. Item number 10 is to approve the request of the following to terminate vested rights and commence retirement benefits. I have a motion and a second. Please record your vote. Item is approved. Item number 11 is items for individual consideration. Item number 11A is approve amendment number 1 to professional services agreement with BT and Company Public Accountants for professional accounting services. Anyone have any questions on this item? Hearing none, Chair will entertain a motion. I have a motion and a second. Record your vote.
Trustee Janata, how do you vote? Okay.
Item is approved. Item number 11B is to receive the quarterly investment report. Good morning, Jason. Patty?
We're going to split this discussion up this morning. I get to talk about the markets, and Patty's going to tell you how you did. So I brought her along for that fun part.
Yeah.
So we have the year-end report as well as a January update. I will say the most recent 4 months, we've seen quite a bit of a rebound in the markets, but no doubt 2022 was a very challenging year. We saw equities down double digits across the board, fixed income down over 10% for U.S. investment grade bonds. The one bright spot was real estate with a positive return. Really what drove the markets in 2022 was rising interest rates. We've come through a decade of very lenient economic policy with near zero interest rates, forcing investors into longer maturity assets and higher risk assets. And your portfolio benefited. You saw a big run up in valuation through the end of 2021. One of the things we'll talk about after we go through the quarterly and monthly report is just forward-looking asset allocation. And for the first time in several years, our expectations are above what you need to get from a required rate of return. You'll remember last year, the year before, and the year before that, we were coming to you saying our intermediate term expectations, which is for us the next 10 years, are much more muted because interest rates were so low, equity valuations were high. Today, as we stand here today, interest rates are much higher, which is a positive. So a fixed income, which is a big part of your portfolio now, is actually offering some return. And equity valuations are lower than they were in the prior years. And I say lower because we've seen a pretty big correction or run up in the last couple months, and equity valuations, they're not necessarily inexpensive. They're looking more like the historical averages of the last 15 years, particularly for U.S. equities. But if we just turn in the quarterly report to slide 8, you'll see and I'll focus on this one-year column. This is the calendar year 2022. I like if you look at the bar charts, the bars, everything is negative with the exception of commodities. That's really oil and gas. But U.S. investment grade bonds as measured by the Bloomberg aggregate down 13% on the year. On a relative basis, it's while down 13% for bonds is certainly not what we would ever expect, it did provide a little protection relative to equities. If you look at U.S. large cap stocks down 18% as measured by the S&P 500, the Russell 2000 or small cap down 20%. Last year and into this year, we are seeing non-U.S. equities outperform US for the first time really in a decade. The EFI benchmark down 14%, so still down, but a little bit better than US stocks. And then emerging markets down about 19.7. If you look at the quarter, which is the fourth quarter of the year, you will see positive numbers, and the biggest one that stands out there is the EFI benchmark. So that's international developed markets up 17.4%. What we're really seeing happening in the fourth quarter and continuing on into this year is the dollar weakening. That's been a major headwind for U.S. investors investing in non-U.S. Equities over the last decade, is the strength of the dollar. The companies outside the U.S. have actually done okay. If you've, Regina, if you could go forward to slide 11. So this slide, again, looking at the table, those first two benchmarks, the MSCI EFI and the MSCI EFI local currency, those are the same benchmarks. They include the same stocks. The local currency is those companies in the domicile of the company, that country's currency. And if you go out to the far right, on a 10-year basis, those stocks in the EFI benchmark over the last 10 years generated an 8% return. But for U.S. investors, when you converted that back into dollars, you got a 5% return because the dollar was strong. As you sold those companies, it took more to buy back dollars. That ebbs and flows over time. We've been talking about this for a couple of years. Really the period from the financial crisis through the end of 2021 was a pretty consistent period of U.S. dollar dominance. But if we look back the 7 years prior to that, from the tech bubble bursting through the financial crisis, we saw non-U.S. outperform U.S. Starting to see that pretty big move during the quarter and into this year, and you see that in the fourth quarter of the year, the weakening of the dollar actually added about 9% to the return versus local currency. So that's a pretty big bump there. If we go forward a couple more pages to slide 14, this is really the story of the year. This is what happened to rates during the year. As interest rates rise, bond prices go down, but it also had a major re-rating on stocks, particularly growth stocks that have a much longer runway to either profitability or returns. Those were getting, valuations were running up as money was inexpensive, but as interest rates rose, we saw growth stocks sell off pretty dramatically, and stocks overall. If you look at the left side of this page, this is effectively the Fed funds rate, or when you hear that the Fed is meeting in the Federal Open Market Committee, they're controlling the overnight rate. What we're showing here is 90-day rates out to 30 years on U.S. Treasuries. You will see currently that green line at the end of the year, a pretty significant inversion in the yield curve. As we stand here today and at the end of the year, fairly large disconnect between the Fed and what market observers are thinking is going to happen in the months ahead. As rates have come down a bit in the intermediate to longer end of the yield curve. From September to December, if you look at the 10-year stayed about the same. The 5-year was down about 9 basis points, but really if we went back a quarter, which we don't show on here, the June quarter, we did see the 10-year move down quite a bit. I think today the 10-year is at about 370, got down as low as 340, but shorter rates are up over 4%, and the expectation now is that the terminal rate is going to be somewhere, for Fed funds, is going to be somewhere north of 5%. As we look at your bond portfolios, for the most part, you have pretty significant core plus positioning. Western, which is your largest bond manager, what hurt them in the first 9 months of the year, not necessarily intuitive. We think of them as owning a little bit more credit and being able to move into plus sectors. That wasn't really the issue. They actually had a little bit more duration or interest rate sensitivity in their portfolio, and they've been adding to it. So as rates came down, that was a pretty big headwind. More recently, they've benefited as intermediate to longer term rates have backed down. Their performance over the quarter, and you'll see it in the monthly report, is very strong. So they're anticipating weakening in the economy, potential recession, and that's pushing the intermediate to longer rates down a bit. So now, with that backdrop, I'll hand it over to Patty to talk about the total portfolio.
If you want to go to page 20, Regina, we provide an overview of where the market.
No, same report.
Sorry, same report, page 20. We provide an overview of the portfolio in terms of dollars. We talk a lot about percentages and returns. On page 20, it's in dollars. And you can see where you started off the year. At the beginning of the year, portfolio was valued at $900 and almost $66 million, really at a peak there. Net additions were, just under 32 million, and then the return on investment reflecting the down year or the negative return. In terms of dollars, it was down $128 million, with the portfolio value at $106 million for the year. I will say when we look at the January report, that has increased to 800 and just a little bit more than 840 million. So we did see about a $35 million increase just in the month of January. Looking out over a longer term time horizon, if you look at that 10-year, under that 10-year column, you can see the portfolio was valued at $544 million. 236 million left the portfolio, and the return on investment was almost double of where you started, so just under $500 million. So really strong growth, and you see that when you look at the returns, really strong growth over the last 10-year time horizon. Moving on to the next page, on page 21, kind of call this a report card page, and what we do is we look at how is the portfolio done relative to different objectives. And so first here we have the actuarial assumed rate of return, which is currently at 7%. Has the portfolio met that objective over 5 years, and has it met it over 10 years? And you can see over a 5-year period, the return has declined to just under 5.5%, so not meeting that absolute return target over a 5-year period, but over the 10-year period has, with a 7.4% return. In addition to a relative return objective or the absolute return, we also look at a policy index, which is more of a relative return objective. And we say, how did your portfolio do relative to the broad markets? And over a 5-year period, the policy index was at 5%. So you outperformed by roughly 40 basis points there over a 5-year period. And then over a 10-year time period, the policy index was at 6.8% and the portfolio was at 7.4%. So you met that objective. And then we also look at some other statistics in terms of risk. How is the portfolio structured when we look at it on a risk basis? Is it taking on more risk to achieve those returns, or is it taking on less risk to achieve those returns? And ideally, we want to generate a higher return while taking on a little bit less risk in the overall portfolio. And so we measure the risk or the volatility by the standard deviation. And over a 5-year period, you can see you want your portfolio number to be less than the standard deviation. And you can see meeting the objective on both time periods, with less risk over the 5-year period and less risk over a 10-year period. And then we also look at what we call beta, or how much sensitivity does the overall portfolio have to markets. And again, we want this number to be less than 1. And meeting the objective there on both time periods. And then lastly, and we haven't talked a lot about this because the markets have done so well over the last 10 years, but it's important to participate in the up markets, but it's also equally important to participate in the down markets, because if you can protect some on the downside, it takes less to make up when the markets do rebound. And so here we look at the down capture, and over a 5-year period, down capture is 100, and your portfolio is at 92.3. So that's saying if the market was down 10%, your portfolio would be down less than that, around 9.2%, so protecting on the downside. And then looking at that same statistic over a 10-year period, a little bit better, you can see your down capture is 91.4, so portfolio would be down 9.1% if the market was down 10%. So achieving all objectives over the 10-year period, but over a 5-year period, just short of the 7% absolute return target. Maybe flip to page 24. Just look real quickly at returns relative to the policy index as well as the peer group. And if you look at the far right, kind of the numbers on the far right column, you have the return of the portfolio for the fourth quarter at 4.4%, over 1 year, 13.4%, 4.5% over 3 years, 5 years, a little bit north of 5%, and then 10 years to 7.4%. And then we look at that relative to other portfolios that have similar equity allocation, but I think even more importantly, relative to other public fund defined benefit plans. And how does your portfolio compare to other defined benefit public funds? And really, we focus on a longer-term time horizon. So if you look at the numbers, over 5 and 10 years, really over 3, 5, and 10 years, ranking, in the top third among other portfolios that are trying to achieve the same objective, other pension plans. And then also, just looking at the chart on the bottom left-hand side of the page, we have the calendar year returns here, looking back over 10 years. And you can see, double-digit returns for 5 out of those 10-year periods, Very strong returns over the past 10 years. 2019, 20, and 21, much stronger than what we would have ever expected, and really kind of building up a cushion. And then you have the negative return of 13.4% for the trailing, for 2022. And so you've built up some cushion there to help provide some protection for a negative year. But very strong results over the past 10 years.
To remember with that, from an actuarial standpoint, the 2019, 2020, and 2021, you didn't recognize all of those gains above your 7%. You banked some, if you will, of that excess over 7%. So even with this down 13% this year, it won't have as significant of an impact on your funded status because you'll recognize gains from prior years that you didn't recognize yet. It was the same last year. You didn't recognize all the gains in your 2021 valuation. I don't know how impactful, but it should be pretty significant.
And then on page 25, I just wanted to focus your attention to this chart, this 10-year risk return chart that we have on the top left-hand side of the page. This provides a graph in terms of the risk return. And so you really want to be in that upper left-hand quadrant. So your portfolio is represented by the light blue square, and then the policy index is the dark blue square. And so you have achieved a higher return over the trailing 10-year period while taking on less risk. And then if you move over to the right-hand side, kind of the middle of the page, the benchmark relative statistics, we look at the up capture and the down capture over a 10-year period. And you can see, again, the portfolio is protecting on the downside with 91.4, and you're participating in most of the upside at 97.7. So it's kind of the reversal of what I was previously explaining on the down capture. So on the upside, if the market was up 10%, your portfolio will be up 9.7%. So many different factors that we're looking at when we're, making our recommendations and constructing the portfolio. And we'll talk a little bit more about this when we look at the asset allocation, but always want to be looking at the risk and how much risk you're taking on to achieve the returns.
What's a realistic expectation on the downside capture?
I think that right about where you are.
Okay.
As we look at other portfolios, your down capture statistics, I'd say, are a little better than what I'm seeing across other client portfolios. Down capture for most of our client portfolios is around that 90%. Your up capture is a little bit higher. And if you look at that lower left chart, a lot of that came in that 2020 and 2021 period. You had really, really good manager performance. And as we'll talk a little bit about just relative performance over the past year and where it was coming from, your large cap allocation was a bit of a headwind this year. It's your largest allocation, and I talk about this quite a bit. It's primarily either passive with the SSGA strategy or what we call benchmark risk controlled with Intech. That Intech strategy tends to own a little bit more of the smaller names within the large cap index. So when small cap outperforms, they do a little bit better, or when smaller names outperform, when large cap outperforms, they do a little bit worse. This period, more recently, the month, they're doing very well, but overall last year they trailed a bit, and that was a headwind. In that period of coming out of the bottom of COVID through the end of 2021, that really helped, and that improved your up capture. You know, any down capture lower than 90, the up capture is really gonna be much lower than I think is desirable for a pension fund that
Has
really-
a 7% return.
7+% return. You have a long-term time horizon. Bringing that down capture down too far, you'll be like, well, we're not participating as much as we'd like to. That's hard to do. If you
I'll
want
just-
to
yeah, go ahead.
briefly go to the monthly report.
Yeah,
Let's vote on both.
Was there any other questions before we?
We only have to go around.
okay. Yeah, okay, you go ahead.
Okay. Flip to page 4 of the monthly performance, so it's a staple piece for those looking at the hard copy. You know, as Jason mentioned, really saw a rebound in the fourth quarter of last year, particularly in October, November, and then January was a very strong month. So on page 4, we have the value of the portfolio as of the end of January, $841 million, up from where we were, you know, at the end of December. We have their target allocations and then where the actual allocation is at the end of the month. And you can see when you look at overall equity, you know, your target is 65%. You're just shy of that at 64.7%. Fixed income target is 20%. You're a little bit lower there, but your cash is a little bit higher. And we'll talk a little bit about that. You received a couple distributions in the month of January. We put in some redemption requests for real estate, and we received some money there, as well as from a couple of the equity long-short managers. So cash is a little bit higher than it has been. But when you look at those two combined, right in line with the 20% target. And then real assets, which represent, you know, your core real estate and opportunistic real estate, in line with the target. Core real estate is a little bit overweight. We did submit a $15 million redemption request from Morgan Stanley that was effective December 31st. You received a distribution of about $3.7 million there. There is currently a redemption queue in place, but that $3.7 million represents about 25% of the overall, you know, of the $15 million, which is much higher than what we've seen some other real estate managers. Given what's happened in the overall markets, equity values have come down, bond values have come down, and real estate has done very well over the last 2 years. So 2021 was a very strong year, 2022 was a very strong year for real estate. And so other plans like yourself have gotten a little bit overweight in real estate because the other parts of the pieces are going down and real estate's going up. So many investors have submitted redemption requests, and within real estate, it's private, you know, real estate in major metropolitan cities. You can't just go out and sell that real estate. So they implement these redemption queues and will pay it out over time. And it's likely that at some point, as the equity markets and the bond markets rebound, that will likely resend, if they haven't paid out that full $15 million yet, that will resend that redemption request as the equity and bond markets rebound.
And you're in a little bit different position because you have a lot of unfunded commitments on the opportunistic side that we would anticipate they'll start calling capital down as prices come down in the real estate market. The opportunity for the Starwoods and Angelo Gordon and Blackstone is going to be pretty ripe.
One of the questions I would ask is, when you look at real estate, when you look at how we've had a good 2 years, is it in the multifamily? Is it in the commercial? Is it industrial? Where are you seeing the value add?
21 and 22, multifamily and industrial were huge outperformers relative to office and retail. Now you're starting to see some markdowns in portfolios, as we would expect, just because it's run up so much. Interest rates have gone up. So that has a negative headwind for real estate. But the real return came in industrial and multifamily.
Okay, because I keep hearing, you know, with teleworking, you're going to see a big thing hit office and that kind of stuff too. So that's always a concern that we have here in the city, just as we look at our tax base.
Well, Morgan Stanley, along with most of the, what we call Odyssey, the core real estate funds, for the last several years, been repositioning portfolios where you have a lower than benchmark weight in office and retail, and really adding to industrial and multifamily. That said, Morgan Stanley will, they have quality office. So where their office they're generally close to fully leased and in decent shape. They just have less of it than they did previously.
Also depends on what segment of the market you're in, whether, one area that is growing is kind of the health sciences and healthcare industry, office space for that, more demand there. And so you could also potentially see some turnover in tenants and things like that. But that's an area that is actually growing and is strong today, whereas, maybe an office in San Francisco that was a high-rise for financial district maybe isn't doing as well. So it depends on where you're at, where the properties are held. Any other questions?
The other thing, and Patty mentioned it, just looking at the cash, and that's more a function of distributions, and we raised a little bit more, and you have capital calls that we have to anticipate. But currently now, you're getting over 4% on your cash in short-term investments, whereas before, it was more of a drag. Now it's contributing, and we look at it more part of your fixed income.
On page 5, we have the results for the portfolio, as of the end of January. You can see portfolio on a net fee basis was up 4.8%. That second line and that light blue box, 1 month return, 4.8%, slightly behind the policy index, but, longer term results, 5.8 over 3 years, 5.3 over 5 years, a little bit north of 7% over a 10-year time period. As Jason mentioned, you're slightly below the policy index, and a lot of that has to do with Intech is one of your large cap manager. It's one of the largest allocations in the portfolio, and they tend to overweight the smaller names within the index, and so that's contributed to the lag a bit versus the policy index. But when you look down at the individual composites, and we look at each asset class, so you can see large cap equities down about 8.5% versus the S&P 500 at 8.2%, but longer term results very strong, 9.2 over 3 years, 8.9 over 5 years, 12.4 over 10 years. Small cap portfolio, has protected some, down 0.06% for the 1 year period, where the Russell 2500 index is at 2.05%, and then longer term outperforming there. Long short equity had a tough year in 2022. When we look at the 1 year return there, 6.5% versus the equity at 7.5%. I will say that
Those are negative.
Sorry.
Negative.
Sorry, negative. Yeah. A lot of that came in the first half of 2022. The second half in January have been fairly decent for equity long short. If you look at just at the 7-year return, you can see, and we don't have this here, but I've written down that equity long short portfolio was up 8.9%, whereas the equity was up 9.8%. So capturing most of that upside in the last 7 months. And then international and emerging markets, as Jason mentioned, really prior to the fourth quarter, impacted by the strength of the dollar, starting to see that come back. One of emerging markets is one of the best performing asset classes in the month of January. International developed markets, you have 2 managers there. You have Lazard and Harding Loevner. Harding Loevner tends to be a little bit more growth oriented, and they also have a fairly healthy allocation of 25 to 30% to emerging markets. So their portfolio was impacted due to an overweight to technology sector, as well as having an allocation to emerging markets, which did not do well prior to the fourth quarter. And then also Lazard is an international development manager that has a value bias, but it's a little bit more conservative in that it's more conservative than Harding Loebner, so it serves as a good complement, but it's not deep value, so to speak. So they didn't do as well. Some of the value managers, they have an overweight to materials, and energy and financials did really well, and they have had a lower allocation to those segments of the market. And then emerging markets down 16% for the 1-year period. 2 managers there. You have Allspring and Wasatch. Wasatch represents a very small piece of the overall portfolio. It's 1.5% and is really designed to kind of be a return enhancer. They're investing in emerging markets, which tends to be a little bit more volatile or a little bit more risky, but they're also investing in smaller cap names. And so looking at their portfolio relative to Allspring really is not an apples to apples comparison. It's designed to compare. But small cap stocks did not do well in emerging markets in 2022. They also have a higher allocation to technology, which was one of the worst performing sectors in the emerging market allocation. Their weighting is about double there, so impacted returns. But just keeping in mind, it represents a very small piece of the portfolio when you're looking at their returns. And then lastly, fixed income. You have 4 different managers here. Provided some downside protection at 8.3 versus the Bloomberg Ag at 8.36%. Really over the last several years, we've been diversifying and complementing the fixed income managers relative to one another. You do have Brandywine in your portfolio, which is a global bond manager that they have a lot of exposure to currency. So they've also benefited from the dollar weakening over the last 4 months as well. And then lastly, you can see cash and equivalents, and the return there over the 1-year period is 1.6%. But as Jason mentioned, you're actually starting to earn something on cash now, and you can see that in that 1-month return, 0.35. If you took that out and multiplied it by 12, to kind of get a 1-year return, you'd be north of 4%. So it's nice to actually get paid for holding cash nowadays.
So any questions on the report before I turn my attention to forward-looking asset allocation?
What we'll do, sure my mic is on, we're going to go ahead and vote on items 11B and C. There won't be a vote on item D, so Amy's instructed me that we need to vote on item B and C, so. Okay. All right, Chair will entertain a motion to receive the quarterly investment report, which is item 11B. I have a motion and a second. Record your vote.
I vote yes.
Did we time out? We're going to have to do a voice vote because we timed out.
I think just you.
Just me? Oh, I timed out. Yes. Well, I was here early. That's why I timed out. Item is approved. Okay, there we go. And then we'll vote now on item 11C. Chair will entertain a motion. The motion a second. Record your vote. Yes. Oh, you refreshed me, okay. Item passes. Now we will move along to item 11D.
Okay. So once a year, we revisit the strategic asset allocation. Just to frame this is more of a policy discussion as to where we want to be from a long-term strategic targets. I think as we walk through this, it's intended as a discussion, but there may be some takeaway to make some modifications to your policy, which, depending on the board's desire, we can come back next month with your policy document with some red line changes, if that's the direction you choose to go. So I've given away the punchline for most of this the last several months, but if you just turn to slide 3, we developed 2 time horizon capital market expectations, what we call intermediate term time horizon and then long-term time horizon. Our intermediate term capital market assumptions for us, that's really the next 10 years. So many might say that's long-term, but for the types of clients we're working with that are all very long-term investors, we're calling that intermediate. And those assumptions are anchored more on current yield and current valuation when we think about equities and fixed income and real estate. So from year to year, they may move around a little bit more than our long-term assumptions, which are really anchored on very long-term historical averages. And those shouldn't move around too much. As we incorporate these into our asset allocation modeling tool where we do Monte Carlo simulations and show output of various mixes, typically the way the model works, or the way the model works is it will show you an outcome over a 10-year time horizon, which is using the intermediate term assumptions. And then if we move out beyond that to 20 or 30 year, it's blending the intermediate assumptions with the long-term assumptions. The last several years for pension funds like yourselves, if we looked at the intermediate term expectation, the median, it was more like what you saw in your actual 5-year return of 5.5%. I think last year, we have it in here. It was, you don't have to turn the page. It was 6.3% was the median expectation for your policy mix based on our capital market assumptions a year ago. So that's well below, that was looking out from January 1 of 2022 over the next 10 years, they're saying, well, we expect about a 6.3% return, 50% probability. So that's below your 7% target. If we took that out longer term, we had a better chance of getting to that 7%. But as we would say, you have to get through the intermediate term to get to the long term. Today, because yields are up, valuations are down, things are looking a lot better as we look forward. Where we sit today, we're better positioned for a long-term investor that needs a 7% return, better positioned for the next 10 years than we were a year ago or 2 years ago. So basically, equities are higher due to lower valuations, fixed income higher due to rising yields, real estate modestly lower. Brent, this is somewhat to your question, I think. Not dramatically, but modestly lower due to lower cap rates. So cap rates are the inverse of a price earnings valuation. It's the income on a property relative to its price. And because prices on real estate went way up last year, that earnings, if they didn't move, it's a lower yield. And so that's going to force valuations down, if you will. That said, from an asset allocation standpoint, on a relative basis, real estate still offers a premium return to bonds with less volatility or risk than equities, and it provides the same correlation benefits. That hasn't changed. The one thing, bullet there, that might create questions is that inflation largely unchanged. Again, this is looking out 10 years forward or longer. Those inflation assumptions actually went up a couple years ago. They went up quite a bit, by over 100 basis points. If we look backward 10 years, the 10-year inflation number went from 2.1 to 2.6. So we're still not, looking out over a 10-year period, it's not the year-over-year number that you're hearing in headlines today, that 7.5%, 8%. We're looking out either backward or forward longer term. And that actually, that one factor in the model for inflation, that isn't based on modeling, that's based on what the market is telling us. That is the 10-year TIPS break-even point, the Treasury inflation, that's what it's yielding today. So if we go to the next page, I think this is just, it's somewhat interesting and enlightening just to show the impact of 1 year, what it does to your longer-term results. So this is backward looking. That top line is your portfolio, net of fees at the end of the, December 2021. Your 10-year return on your portfolio is 9.76% annualized over that 10-year period. So that's well north of your 7% hurdle. Now, your hurdle was more than 7% for points in time over the last 10 years, but it was never 9.7%. So you were booking surplus, if you will, over that 10-year time period, and indicate, pretty good indicator that maybe the next 10 years aren't going to be so great. Well, this 1 year took a lot out of that, took a lot of steam out of that. So the negative 13.7% return for 2022 eroded the 10-year return by almost 2.9%. So your 10-year return at the end of 2022, 6.88%. Surprisingly, pretty close to what we were modeling for a 10-year forward number at the beginning of last year. I don't know what it would have looked like if we looked at this back 10 years ago. But then you can see the various indexes and how much they came down in a 1-year period. And this is what's really leading to those intermediate term assumptions going back up a little bit because you had such an erosion in return or valuation in 1 year. The next slide, you've seen this the last couple years, I think. What this is showing is, this is looking at the S&P 500, so U.S. large cap stocks. But that valuation is a pretty good indicator of future return. Current valuation is a pretty good indicator of the future return. Now, our modeling isn't quite this simple, but this is a fairly simple picture. So the purple dot is showing where the price earnings was on the S&P 500 a year ago. So the valuation, what the price was relative to earnings. At the end of 2021 was about 25 times earnings. That's the horizontal axis. The vertical axis is an indication of, okay, when valuations are that high at 25 times, typically the next 10 years we've seen about a 5% return. Meaning, we're starting pretty rich valuations. The next 10 years, that's what's happened historically. At the end of 2022, valuation had come down about 25%. So it's, right, I'd say that's at about 17.5 times. Historically, when valuations that are about 17.5, the next 10 years, we're seeing about a 10% return. So historically, we're just in a better spot. But I will say that PE or that valuation, it's still that we're at about the historical average. We're not way overvalued, we're not undervalued. Things aren't cheap, we're at about historical averages. The next slide looks at fixed income, and this is much more dramatic, both where we were last year and where we are this year. So last year end, the yield on the aggregate was almost off the chart. We don't really even have any observations down that low. We were down below a 2% yield on the U.S. investment grade bond market. The going in yield is much like valuations for stocks, the going in yield is a pretty good indicator of the next 10-year return on bonds. The simplest way to understand that is a 10-year treasury bond. If you were to buy a newly issued 10-year treasury on January 1 of 2022, that was yielding 1.8% and at issue, and you held that for 10 years, you're going to get 1.8% a year and then get your $1,000 back at the end of the 10-year period. If you bought that same bond at the beginning of 2023, that 10-year treasury was yielding like 3.8%, and you hold it, so that's 200 basis points more. This is looking at the broader bond market, so there's credit and other factors, but that's a pretty big move for fixed income yields, and now the expectations for bonds is about 3% higher, which you'll see on the next page. So this page, on the left side, we're showing our intermediate term assumptions in 2022 versus 2023, and then that middle highlighted column is the change in those assumptions. And you'll see some pretty big moves. On the equity side, large cap equities up 2%, small cap about 2.5%, international and emerging, not quite as much, but our starting point was a little bit better for emerging and international because valuations in emerging and international weren't as rich a year ago as U.S. stocks. U.S. stocks have gone through a 10-year period of outperforming non-U.S., so you don't see that quite the significant move up. Fixed income, we're blending really what you're doing in a diversified fixed income portfolio. We're looking at this as what we're saying is 80% core plus, which is your SSGA, core strategy, Western, and Brandywine as core plus, and 20% more unconstrained absolute return, which is the PGIM strategy, which is going to move they're going to move their duration around and be a little bit different. But if we blend that all together, it's about a 3% premium to where we were last year. So what does that do when we look at your current mix? Well, the number one thing is fixed income now is attractive. It's offering a return that it hasn't in some time. The last 10 years, it's really just been principal protection and liquidity. Now we're getting a little bit of return there. If we go to the next page, we do the modeling. We show 3 different mixes. We show your current is your current policy targets. This isn't where you are right now. We're deviating a little bit just due to market movement. But your current policy targets are 65%, 20% to fixed income, 65% to equity, and 15% to real assets or real estate, and those 3 broad categories. Within that, within equities, so that's broken down a little bit more granularly. 18% U.S. large cap, 10% small cap, 11% international, 6% emerging, 10% long short, and 10% private equity. The private equity, that was just bumped up a couple years ago from 5 to 10 because it takes some time to get that allocation up to targets because we can't just move money there. One of the things about private equity that we like a lot for long-term investors is that it's a very long-term asset class. There is a premium return for private markets due to the illiquidity premium that you as a long-term investor that doesn't really need the liquidity can take advantage of. And that's why we're showing an alternative mix where we stay at 65% in equities, but we take a little bit from long short, we cut it in half, and we add that to private equity. And what does that do? You'll see the difference between current and mix 1. We're just flip-flopping, cutting long short in half and adding that to private equity. It actually adds to the return, the median, by about 30 basis points, and it slightly increases the volatility, not much. The Sharpe ratio is a bit higher. Sharpe ratio is a measure of efficiency. It's just telling us when we compare one mix to the other, a higher Sharpe ratio is suggesting that it's a little bit more efficient use of risk. The other thing that I think is important to look at is that first percentile return. Think of that as worst case scenario. That is any given year. That's not over a time horizon. It's not next year. It's any given year. There's a 1% probability that any of these mixes are going to be down 18 to 20%. That's really like 2008. I think 2008, a diversified portfolio like this was down about 21%. So this is a little bit better than that. The other thing we looked at, well, first of all, I'll go back. The 10-year median return using 2022 capital market assumptions, you see the big change. We're going on the intermediate from 6.3 to 8. So this is what I'm saying. We're in a much better starting point today than we were a year ago. This isn't saying that we're going to get 8% next year. It's just saying over the next 10 years, there's a 50% probability that we will get 8% or greater, 50% probability to be 8% or less. A year ago, we were saying the probability over the next 10 years, 50% that we'd get to 6.3. So we're much better position today. Mix 2 that we're showing here, we're saying, okay, well, what if we just took a little bit more risk off the table? Again, take from long-short equity and put that in fixed income. Reduce equity by 5%, increase fixed income. That reduces our risk a little bit. It slightly reduces our first percentile return, but it reduces overall return by about 30 basis points. We look at this just because for the first time in a while, fixed income is offering some return. I don't know that we want to, at 65% in equity, you still at 15% real estate, 20% in bonds, still have 35%. So it's non-equity, 65-35 portfolio. We think that for a long-term pension fund investor, we like that a little bit more, but we wanted to show this and say, if you did take down risk, this is what it does. But it doesn't really, volatility or standard deviation of market returns, that difference less than 1% is pretty insignificant for a long-term pension fund. You're getting more volatility reduction from in your funded status and your contribution rate from accounting principles, meaning how your actuarial valuation works by doing smoothing. That's going to reduce volatility more than reducing market volatility by 20 or 30 basis points. If we go to the next page, see this just in a slightly different way. Instead of just focusing on the median, this is looking at the distribution in the range of outcomes. So you'll see over time, on the left side of the page is 1 year. Again, that's not next year, that's any given year. So in any given year, there's a very wide range of outcomes around the median. We're going, if we look at the 25th to the 75th percentile, in any given year, there's a 25% probability that your current mix will get 1.3% or less, and there's a 25% probability that it could be 16.4 or higher. As we move out in time, we go to 10 years. What I like to look at is kind of that 25th to the 50th. So not paint quite a rosy picture, to say if we're average market to slightly below average, the expectations for this portfolio, the current, is about 5.7 to 8. Mix 1 moves that up a little bit to closer to 6 to almost 8.5. So if we're thinking about your 7% return hurdle, that probability is getting better. I wouldn't look at this and, I mean, you've done a very good job historically of bringing that, being a little bit more conservative in your approach with your return expectation. And CEPRS just came out with their new survey of public pension plan sponsors yesterday. Most of the data in that is from last year. No, it's not reflecting any updates plans have made this year, but the median expected rate of return is down under 7%. So you're not even at the bottom now. It's like 6.8%. I've had some folks look at this and say, well, should we be raising our rate of return expectation? Our answer is really no. You don't need to do that. All this is suggesting is that you didn't lower it down to 6.3 last year. What this is saying, there's a higher probability of getting your 7% hurdle today. Finally, the last slide is just downside probability, and I think that, one more is, this is your return probability, and you see that, again, I'm focusing on the 10-year. Mix 1, which increases private equity a little bit, but keeps equity the same. We're highlighting that very top line. These are probabilities of achieving your hurdle rate. So the probability actually goes up by about 2.5% with Mix 1 versus your current. Mix 2, it actually goes down, where we take away from equity and add to fixed income. The probability of getting to your hurdle rate goes down. This is based on 2023 assumptions. If we looked at this relative to last year's assumptions, across the board, the probabilities have gone up. You're probably, just because the expectations are higher. The last thing I want to just point out, this is not necessarily looking at worst-case loss, but this is looking at probability of loss, so 0% or lower. I think this is just important to understand for trustees. Any one of these mixes, because we have 65% in equity, in any one year, that's the left side of the page, in any one year there is a 21% probability. So 1 in 5, slightly more than a 1 in 5 probability that you're going to be flat to negative in any one year. So, as we looked at the last 5 years of returns and you had those 17, 12, 19, negative 13, that this is not to be unexpected. As you move out in time, though, over rolling 10-year periods, rolling 20-year periods, the probability of being flat to negative goes way down. And I think the last 10-year period where we were, it was the end of 2008, you had 2 years in that 10-year period, 2001 of the tech bubble bursting and 2008 in pretty short order of time where you had big negatives, that the positives in between didn't offset that and you had about a flat return. But that's certainly within the realm of possibility. So if you go back to that mix page, keep going, there we go. As we look at that, and we look at other iterations, we don't just focus on these three, but we wouldn't look at major changes, but we do think contemplating a move to mix 1 as a strategic target does make some sense. And we wouldn't have gone there previously because it takes time it doesn't make sense for us to show you 15% private equity when you're at 3, because it takes time to get there. So now that you're at 10,
8.
or you're at 8, this would be, from a target standpoint, it's an increase of a third in your target. It's an increase of almost 50% from where you are today. It would take some time to get there, but we think it makes some sense. And from a liquidity standpoint, it doesn't change the overall liquidity. You still have 65% of your assets in what we consider very highly liquid. For a public pension fund, this is well within what we see across the board. You have more than, when I talk about liquidity, I'm talking about, do you have enough to pay your benefits on an annual basis that's not locked up? And 65% of your assets today are in investments that can be turned to cash in a week or less. That doesn't change things. It actually, it does change what's illiquid. That goes up to 20%, but we're still well within the bounds of what we would consider more than reasonable. It would take some time to get there. This doesn't contemplate really moving money around. We're just talking about changing strategic policy targets and then moving toward that over time. So we wanted to present this to you, I guess, get your feedback. If there was some inclination to move to this, we would come back with the policy document that would reflect whatever changes you were comfortable with to be considered at the next meeting.
Well, we will take that under advisement, and either myself, or more than likely it'll be Regina, we'll get back with you and let you know, maybe bring something for next meeting. Okay? We do not have to vote on item D because it's just a presentation. We're not receiving anything. So we will move ahead to item 12, which is comments from board staff and citizens. I have one comment. I would be entirely remiss if I did not mention that this is Mr. Lawson's last meeting with us. He will be retiring from the city on March the 2nd, will be his last day. He's not only leaving a void with the retirement system, but he's leaving a void in my office because he is my right-hand man when it comes to all things financial. So fortunately, we have already selected his replacement, so it won't be as bad as it's been in the past where one person left and the next day the next person showed up. So I want to publicly thank Marty for his service and wish him all the best in whatever he chooses to do in his retirement endeavors. So.
May I say something?
Absolutely.
Okay.
It's your last chance.
It's my last chance to get it in. Well, thank you, Paul, for that. I have to express that I've really truly enjoyed being on here, and if I have any regrets about retirement, it truly is that I have to give up this seat. There's so many things that have been learned over the years and so many relationships that's built. Serving with people I know, Randy, I think I first met you in a CPA, continuing professional education conference, and you were a high flyer back then. I mean, wow, the speaking that you did and the recognition, your company, it was pretty special. And Brent, you know, we go back pretty far too, back to when I was in accounting, and I think, where were you? You were in the budget office back then in days. And a lot of things that we shared in our times. Matt, I remember you being was it with Cooper that you were the auditing firm for the city? And I think we first met then, and then later on you came in and with the city. So that goes back. And Amy, my goodness, I think in the budget office you were just a clerk then, weren't you? Working for Craig Freeman as he was the budget director, and you were working the front desk, and here you are nowadays at the city clerk. So quite a career you've had, and it's been a joy watching you get that and be there. Paul, my
Careful,
goodness, okay,
careful.
Yeah, here we go.
Careful.
Ken asked if I remember back when you had hair. I'd say, I don't know. I think you
Ken?
had a little bit back then. But
There are
yeah,
pictures.
I think you were leaving the budget office just as I was coming in. I came in 1991, so I think you had just gone to Public Works, hadn't you?
Just in time. Actually, October of 1990.
Yeah. Humble starts. You started at what, as an admin coordinator or a
Admin assistant.
admin assistant?
Boy.
Yeah, and just kind of worked right on up there. Mr. Brum, I think, treated you well, and then you finally came over to General Services as my boss, my director, and it's really changed. It's a great, fun place to work. We have a lot of laughs. We get work done, but we have fun doing it. JC, I remember you from about the same time, right? You were Paul Brum's first IT person that he hired on, and still serving there and doing that and keeping everything running. And I always remember you about your funny post in Facebook, and if you want to look for something that'll make you chuckle, you know, you look to JC on that. Carla, you were my accounting supervisor back in the day. Yeah, what was I? I was a municipal accountant 2, and back then municipal accountant 3 was the highest you could go before you went to be a controller. So big gap in there. I think nowadays there's probably 2 or 3 levels in between there. But yeah, you were certainly a blessing to work with. I always appreciated your wit, and you were so smart. And of course, all the stories about, you know, your son and him growing up. He was just a young shaver back then. Now he is all, you kept him fed and watered all these years, and now he's all grown up. Yeah, and Ken, I really appreciate sitting next to you. It's kind of interesting. I always thought Ken was this serious guy, you know, maybe I shouldn't talk to him, not sure about that. Then you get Ken off the side and you find out you're quite the cut-up. I imagine there's a lot of elementary teachers that had a discussion with you back in the day about talks too much in class. Exactly. Yeah. And Amy, it's been kind of nice knowing you. You were personnel, and then you left for a little while and come back, and my goodness, I don't envy your job with all the work that is there to fill all of those positions and challenges that we have and just trying to get people to take a job and get them through. It's quite a bit. But that's kind of the big memories I have, and I'd just like to kind of finish up by saying that I appreciate also, Paul, your allowing me to be on this board through the nomination process, and all of those people that filled out those ballots and allowed me to be here. I really appreciate their support for me too. That's all. That's it. Appreciate you all. Thank you.
Well, all right, Marty, thank you. Anything else for the good of the cause? Hearing
Remind you,
none?
it's on the end of the agenda, but
we're right.
ACG is hosting lunch for anyone that didn't respond. The invitation's open. Just traipse on over to Flint.
Okay. No business will be discussed at lunch. We'll be too busy eating. So, thank you very much, and we are adjourned at 11:10.